Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. One of the biggest attractions of buy, refurbish, refinance strategy is the idea that you can recycle your money over and over again. You buy a property, add value through refurbishment or lease extension or planning gain or whatever it may be, you refinance it and then you pull all your capital back out and you move on to the next deal. Now that's the ideal scenario. In theory, that's fantastic strategy because your money keeps working for you. But in reality, the property investing isn't always that neat. Build costs go over budget, surveyors don't always agree with your expected valuation, interest rates move, legal costs increase, unexpected repairs appear, and before you know it, instead of pulling all of your money back out, you're left 10,000, 15,000, maybe 25,000 behind in a deal. If you do that 2 or 3 times, suddenly the pot that you had and relying on to fund the next purchase is getting smaller. In today's episode, I want to explore a similar concept that can help you preserve the momentum over the long term. And this is what we call keep two, sell one approach. So why is buy, refurbish, refinance so powerful? So this is one of the most common investing strategies within property where you have a pot of funds, you use it, and then you obviously you buy, you add value through whatever purpose you can add value, usually through refurb. So buy, refurbish, refinance, you recycle the capital and you repeat the process. And that's the ideal scenario. Now that's on the basis that all of the money comes out of the deal and those deals are becoming harder and harder to do. And that's the holy grail. That's what everyone's chasing. But the reality is those are difficult. So what happens is generally you leave a little bit of money in the deal and then it takes a bit of time to recoup that money through the rental income. The engine behind BRI isn't the refurbishment, it's the ability to recycle your capital. So as I said, the reality isn't always perfect. Unfortunately, deals don't always perform as they do on a spreadsheet. So refurbishment costs increase, delays add finance costs, valuations come in lower than expected, rental assessment isn't quite as strong as you expected it to be. Maybe the interest rates are a little bit higher than when you first stressed the deal. And obviously refinance criteria might have changed because the market might have changed. So suddenly, instead of getting all of your money back out, you leave some money in. Now, those of you who've done any deals that are listening to this will know exactly what that looks like. Experienced investors will have done deals where they've pulled all their money out of deals. We've done that. But also you'll have deals where you leave more money in than you wanted to. And nothing always goes to plan. So if you start out, and this is key for people who have a pot of money that they want to invest and build momentum over time, property investing is a cash intensive game. And if you are going to play the game, then ideally you want to try and find money from elsewhere, be that investors. But a lot of people don't want to work with investors. They just want to do their own deals with their own funds. They don't want to have to rely on anybody else. So if you've got a pot of funds that will only go so far, then you've got to consider your strategy. So, if you use an example where, you've got 100,000 in a deal and you're expected to recycle that 100,000 cash back out, but you've left money in, you've actually recycled 85 grand. Then you move on to deal 2 and you're expected the 85 grand back out, but you've actually recycled 72K. All of a sudden that 100 grand within 2 deals is left with 72K. And it's starting to squeeze you now because you're struggling to find deals to work with the cash that you need to buy it, whether that's as a deposit or just purchase it fully in cash with stamp duty, fees, solicitors, valuations, refurb, etc. So small amounts of trapped capital become a big problem when they're repeated over multiple deals. And this is where momentum starts to slow. So it isn't, one imperfect deal. It's those deals that you leave a little bit each time and eventually you run out of enough of a pot to get the next deal. So what happens? you need to consider other options. So one of the classic momentum strategies that people use, and this isn't our concept, this is just something that we've learned over time, is you keep two, sell one, keep two, sell one. So whenever this happens, you replenish the pot, you lose a bit of money, you replenish the pot. So you take some profit. So you've got asset play and keep in two, and then a profit play with a flip on the third deal. So, what you'd like to do is keep building those long-term assets, but eventually you will run out of that cash. You need to realize some profit. And then that profit replenishes the capital that you've left in the deal. It rebuilds contingency funds, it funds future deposits, and it releases some of that trapped equity. So think of it as resetting the engine, and sometimes sacrificing one deal today helps you keep that momentum going for the next deals and the future assets. Because if you don't buy anymore, eventually you will run out of cash, and then the whole game comes to an end if you're not prepared to find money from elsewhere. So, like I said, easily done to rules in, but what you can, so if you leave in, if we use the first example where, you went from 100,000 down to 85, and then from 85 down to 72, you could then do a flip. And as long as that flip comes with more than 30K's worth of profit, then your pot is back over the original 100 grand again. So think about, it's not just about the negative side of it where you think, well, I'm doing all of this work and I'm not doing an asset. I'm not keeping an asset. It's rebuilding those funds so that you can keep going. So the pros and cons. So pros are, it maintains liquidity, which means you've got cash in the bank. You've got your contingency fund being rebuilt. It reduces your reliance on borrowing. It helps fund those future opportunities, and it creates more flexibility. The disadvantage, yes, you're selling an asset, in which case you're losing out on the long-term capital growth of that property. You're also missing out on the future rental income of that property. There's more costs involved with selling, solicitors and estate agents, etc. And there will be some tax implications. So you need to run the numbers and make sure that it makes sense and you're not just doing it for the sake of it. So there's no right or wrong answer, but it's just understanding your business and how it's going to be financed over the years to come. And it's just taking more of a business approach to your investing, and it's a mindset thing. It's rather than thinking, I'm selling a property, it's thinking I'm recycling capital into the next stage of the growth of the business. Every successful business generates cash, reinvest cash, and protect cash. And property investing is no different. It's just how you manage the cash flow within the business keeps the lights on effectively. So this might make sense if you are in a position where you're always looking at your bank account and you're wondering, things are looking thin, and if some work needs to be done on a property, some maintenance, and you have an invoice, an unexpected invoice, and you can't afford it, or if you've had a tax bill that you hadn't kind of planned for, corporation tax bill you hadn't planned for, those are the types of things they're thinking, well, cash is tight, then you need to consider that. If you're always pushing the boundaries of the cash that you've got for the next deal and really squeezing out the majority of the cash that you have, again, cash is tight. And as the market, there's more demand in the market, values are going up, you need more cash. So it depends on the market. And, with the rising costs of inflation around refurbs, you want to make sure that you've got a bit of a bigger contingency that you might have had. So you don't need to do this all the time. You don't need to do it on, every year. And that might just be depending on your cadence, on how many properties you're doing. But you just might want to think strategically around what is a good deal for you. So yeah, just to wrap up, really, a nice short episode and just making sure you understand the BRR strategy. It's one of the most powerful strategies to build a portfolio and keep that momentum going and use the same pot of funds to build a portfolio and build assets. There's no other asset class that you can do this with, but it rarely works perfectly every time. The investors who continue growing over a 10, 20-year period aren't necessarily the ones who never leave money in the deal. They're the ones who recognize when it's time to replenish their pot and keep the momentum going. So whilst keeping every property might sound attractive, sometimes the longer term decision is to let one go, release the profit, strengthen your position, and create the capacity to keep building. Momentum isn't about owning the most properties as quickly as possible. It's about putting yourself in a position where you can keep making good decisions for years to come and having cash flow from those properties. Thanks for listening, and we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.